money might be falling apart, right?
Oh,
How many banks have collapsed now?
Wait, that's happening today?
Is the United States bracing itself for a domino effect of bank failures?
Banks in America suffered more losses. Their stocks were in the red. They plunged by more than 10%. Investors are pulling out their money.
In the US, where some of the world's leading money managers are warning the collapse of another American bank could lead to a credit crunch and an economic slowdown.
The share market has closed well down again after Wall Street suffered its worst hit in 2.5 years because of a crisis with its banks.
Three of America's most crypto-friendly lenders, including Silicon Valley Bank, Signature Bank and Silvergate, collapsed within a week of each other, sparking the new banking drama. A number of other banks, such as First Republic, only narrowly escaped what had been dubbed the first Twitter-fueled bank run in the history of banking. In order to prevent panic from spreading, government and central banks stepped into the mix literally overnight and handed out historic rescue packages and emergency deals to troubled financial institutions. Even so, there is an unmistakable sense of déjà vu about the entire situation. This brings up the question, are we going to see a repeat of the banking crisis in the future? Well, let's find out in today's video. Make sure to watch till the end. In recent weeks, the banking crisis that erupted less than 2 months ago has now been downgraded to a slow bleeding that will seep its way through and act as a catalyst for a much anticipated recession later this year, instead of being a major broadside to the US economy. Banks are reporting that a run on deposits has had a mixed impact on their operations, but the picture isn't all that positive. A number of large banks such as JP Morgan, Chase and Bank of America have suffered much less damage, while smaller banks such as First Republic are facing a much tougher battle and are fighting for their survival. This means that the money pipeline going to Wall Street remains mostly intact and is proceeding as usual, while the situation on Main Street is much more fluid and in flux. According to the chief US economist at TS Lombard, Mr. Stephen Blitz, the small banks are going to be lending less. That's a credit hit on Middle America on Main Street. That's negative for growth. As data flows through in the coming days and months, it will become clearer and clearer how bad things can get. You see, the latest banking drama began a week ago when three of America's most crypto-friendly banks, Silvergate, Silicon Valley Bank and Signature Bank, collapsed within a matter of days. In the end, it was only a narrow escape for some banks such as First Republic from what was quickly dubbed the first Twitter-fueled bank run in history. It was only a matter of time before the stock market panic spilled over to Europe, resulting in the downfall of Credit Suisse, an institution that was listed on the list of globally symmetrically important banks. Within a matter of seconds, Switzerland was close to having to deal with a full-scale bank run with its borders. Investors dumped their shares in mass numbers in several other Eurozone banks, among them Deutsche Bank, which was also under pressure. There is no doubt that citizens, both as bank clients and taxpayers, have been affected in some way by these massive bank rescue programs, at the very least indirectly through inflation. The First Republic Bank, a major regional lender that is seen as a bellwether of how hard the deposit crunch will hit the sector, posted earnings that exceeded expectations but were otherwise reflective of struggling companies. It's clear that bank earnings have been decent for the first quarter, but the future of the sector remains unclear. There's been lots of pressure on stocks, with the SPDR S&P Bank ETF dropping more than 3% in afternoon trading. Citigroup global economist Robert Sockin said in a client note that rather than bringing concerning new information, this week's earnings are confirming that the banking stress stabilised by the end of March and was contained by a limit set by banks. That's about the best macro outcome that could have been hoped for when stresses emerged last month. Despite the banking problems, we expect that the reading on first quarter and economic growth is likely to be largely positive in the near future. As per the Dow Jones estimate, the Commerce Department is expected to report a 2% increase in gross domestic product gains during the first 3 months of this year when it releases its first estimate for the first quarter. Based on the Atlanta Fed's data tracker, an even better gain of 2.5% is forecasted for the year ahead. It's anticipated, however, that the growth will not last in the long term, primarily due to two interrelated factors: Federal Reserve interest rates hike, which are aimed at cooling the economy and bringing down inflation, and the constraints on small bank lending. As an example, First Republic reported that it suffered more than a 40% decline in deposits this year, part of a $563 billion overall decline in deposits among US banks this year, which will make it harder for them to lend money in the future. Despite this, Blitz and many of his colleagues still believe that any recession that might occur will be shallow and brief. He said, "Everything keeps telling me that. Can you have a recession that is not led by autos and housing? Yes, you can. It's a recession created by a loss of assets, a loss of income, and that eventually flows through to everything. Again, it's a mild recession. A 2008-2009 recession occurs every 40 years. It's not a 10-year event." It's actually worth noting that the most recent recession was only 2 years ago, at the onset of the COVID crisis. This was a historically steep downturn and lasted only a short time, but it was followed by a similarly unprecedented amount of fiscal and monetary stimulus, which is still flowing through the economy today. While consumer spending seems to have held up fairly well in the face of the banking crisis, Citigroup estimates that there's an excess of savings of approximately $1 trillion available to consumers. However, both delinquency rates and balances of credit cards are on the rise. Moody's reported on Tuesday that credit card charges off rose by 0.57% in the first quarter of 2023 from the fourth quarter of 2022, while balances jumped 20.1% by the same period. Similarly, personal savings rates have also declined in recent months, falling from 13.4% in 2021 to 4.6% in February. In spite of this, the most comprehensive report to be released to date that was able to take into account the period when Silicon Valley and Signature Bank were shuttered indicated that damage had been contained. The Federal Reserve's periodical Beige Block report, released on April 19th, indicated that lending and demand for loans had generally declined and that standards had tightened, in the midst of increased uncertainty and concerns about liquidity. Mark Zandi, the chief economist at Moody's Analytics, said the fallout from the current crisis seems to be less severe than I expected just a few weeks ago. The Fed report was a lot less hair on fire than I had expected. The banking situation is a headwind, but it's not a gale force headwind. It's just kind of a nuisance. There's no doubt that all that is consumers, because when things go from here very much depends on the consumers, since they represent more than 2/3 of all the economy activity within the US. It's true that the demand for services has started to catch up with the pre-pandemic levels, but cracks have already begun to appear. The increase in credit card balances and debt collection will likely be accompanied by further obstacles of tightening credit standards as a result of both necessity and increased likelihood of a tougher regulatory environment. Consumers who make less than $50,000 a year have been facing pressure for years, as the share of wealth held by the top 1% of earners has risen from 29.7% when COVID hit in 2011 to 31.9% as of mid-2022, based on the most recent data available from the Federal Reserve. According to Jim Bard, Chief Investment Officer at Plant Moran Financial Advisors, before these issues really started to unfold in early March, you were already seeing signs of the economy contracting and the reining in of credit long before any of this started taking place. You're seeing reduced demand for credit as consumers and businesses start to pull back in the deck chairs. However, Baird also believes that there is a slim chance of a steep recession occurring in the coming months. He said when you look at how all the forward-looking data lines up, it's hard to envision how we sidestep at least a minor recession. The real question is, how far can the strength of the labour economy and still significant cash reserves that many households have to propel consumers forward and keep the economy on track? I believe that despite the difficulty of predicting the exact timing and severity of a recession, monitoring economic indicators such as the labour market, consumer spending and savings rates can provide vulnerable insights into the economy's health. Although a recession may be possible, many factors could help support economic growth, including government policy decisions and unforeseen positive developments. How do you guys feel about this? Tell us in the comments. And that's it for today's video. Make sure to give the video a thumbs up and subscribe to the channel for more such videos. Don't forget to press the bell icon to get notified when we update a new video. We'll see you in the next one. Bye.